Okay, hello. I'm here with Vishal Sunak for another episode of SaaS Founder Interviews. Vishal, thank you so much for joining us. Do you want to spend a moment just introducing yourself and telling us a little bit about your company, LinkSquares?
Yeah, Vishal, I'm the CEO, one of the founders of LinkSquares. We play in the legal technology market, specifically today in contract management. So we have an amazing end-to-end contract management platform. We work with in-house legal teams, over 600 of them now. Founded the company in 2015, and I live in the Boston area with my two daughters and my wife.
Fantastic. Okay, so you've raised venture capital. You've done 5 rounds, right, of funding. So you're on your Series C. Is the last round? I think you raised $100 million, if that's correct. And I just thought I'd ask you. We were discussing that there are a few misconceptions on exactly what venture capital is. So I thought I'd ask you about your experience of what venture capital is, and doing these rounds that you've raised to date.
Yeah, so taking money from real venture capitalists different than raising through like high net worth people or like angel investors, right? Angel investments are different. They're done on mostly like convertible notes, and you don't price around, right? You don't establish a price typically. Venture capital, it's a business, right? It's money that people have borrowed from other people. So VC funds, you typically raise capital, right? Like I raise capital as a founder, they raise capital as venture capitalists. They borrow it from people that have lots of cash on hand, like insurance companies, higher education, like universities and schools, endowments and trusts. And so then they have usually like a 10-year fund cycle, right? So they have 10 years to take, let's say they raised a $100 million fund. The first part of the 10 years, they're finding companies like mine, they're vetting them, they're pushing it out, right? They're pushing out the money into companies, they're taking ownership of companies, and then they're continuing to see which ones are doing really well and putting more money in it. So the ultimate goal is the people they borrowed money from, they promised some return. Like, you give me $1, I'll give you $5 back in 10 years, which is actually really great. I mean, probably beats, the stock market these days for sure. It's really important to know that like they're running a business too, right? They operate on what's called 2 and 20. They take 2% of their fund in management fees. That pays for their salaries and office space and supplies and travel. And then they take 20% of the profits that they earn out of their fund, right? So if they make a 10x return, they take 20% of that for themselves. They cut it up through all their team. And then they give the rest of the money back to what they call limited partners. So it's really much like a business model. And understanding that when you take this money, it's like they make a lot of decisions fiduciarily, like about how much they're going to put more into the company. If the company is going well, they want to put a lot more into it. If the company's not doing so well, that's how you hear about how companies end. So that's kind of the roots and nuts and bolts of it.
Fantastic. Okay, so that's really good because I think it clears up exactly where the money comes from and how it's managed, what happens with it. For SaaS founders haven't yet been on that journey. Now, you guys have got to the stage of around $25 million ARR, right? So I thought it would be interesting if you could share with us some of the benchmarks and milestones that you hit throughout that journey.
Yeah. The first milestone, the biggest milestone, is to get one customer to pay you. And for us, that was a company in Boston. They paid us $12,000 a year. So that's $1,000 a month. We had no idea how to price LinkSquares, and it's definitely not as sophisticated as it is now, kind of 5-6 years later. The second milestone I really thought about is like, how do you get to 10 unaffiliated companies, right? Companies that didn't do you a favor, your cousin's brother's uncle's son doesn't work there and bought, like they're completely new to you. They don't know who you are, you don't know who they are, but they bought your product, they found the value. Once you get to those 10 customers that didn't have any reason to buy, they bought because your product is doing something that they need solved inside their business from a B2B perspective. The next real milestone is, how do you keep going and growing to like 1 million of ARR, right? No one is really on the clock on the clock of being benchmarked against all the other SaaS companies. So you're at 1 million of ARR. Once you're at 1 million of ARR, and through that process, you're learning about go-to-market strategy, right? Channels, what channel is working, right? Cold email works really well for us. And no one emails the general counsel of a company, the head lawyer, right? For anything good. Other channels, you have to kind of use that 0 to 1 million ARR to experiment with channels that are working. Maybe event marketing is working really well, or maybe pay-per-click advertising is working really well. It's all about doing things really efficiently, because you don't typically have a lot of cash on hand. Paid advertising can be very expensive for very low returns. So I would say stay away from that until you have more of a bankroll, a bigger bank account to do so. But find the channels that work, track where these opportunities are coming from, double down on the source that's working the most, try a whole bunch of channels, right? And then when you find a channel that's working, you're finding your buyer, you know who your buyer is, you know you're solving the right problem for them. Then the other piece of it is then scaling the product side, right? Which is the more features you make, it makes it easier for people to say yes, they get more value out of the product, they're more likely to stay with you, right? And so that journey to 1 million ARR is like really important. If you've been able to make it to like 1 million, I think it's like, 4% of all companies who try can make it to like 1 million or something like that. Then it's really thinking about how do you continue to like go like pretty fast, right? And the good news is there's so many benchmark reports out there on like what is like elite growth or like just okay growth or kind of like, slow, bad kind of growth, right? Bessemer Venture Partners probably does it the best with their state of the cloud presentations that they do annually. KeyBank has great resources on just benchmarks of companies. So when you start to think about like, okay, it's really working, we can continue to go faster, going 1 to 10 million ARR in 2 years, between 2 and 3 years, like under 36 months, like that's like the world-class benchmark, right? And in order to do that, you'll obviously need more bodies, you'll need more people, you may be raising capital to support it, or you have great cash flow coming in. That's the other thing about venture capital. Venture capital is like rocket fuel. It's like you put it in your rocket so you can go way faster. That's the expectation, right? You don't typically raise capital to sit on it for like 10 years. It's usually like 18 to 24 months of capital that you're really using to rocket boost whatever you're doing that's working. The hypothesis that you've generated is coming true. You're using money to continue to further the hypothesis. Once you can make it to 10 million ARR, then you're really starting to think about things like retention, gross and net, right? Having over 100% net retention is like very attractive, especially in these times. Focusing on the efficiency of your business, especially on the go-to-market side. Like, how much are you spending to acquire a customer? What's your CAC payback, right? Sub 12 months CAC payback is really attractive. That means that customers are actually profitable based on what you've invested to find them in under a year, which is typically like a B2B renewal cycle, right? You think about things on like a year basis, right? Past 10 million ARR, then you're looking at things like gross margin, you're looking at cost of goods sold, which factors into gross margin. You're just looking at the overall kind of burn efficiency. Like you're burning money, you're spending $1, and how much ARR can you get out of it, right? And then a lot of the science then goes into scaling it, 10, 20, 30, 40, 50, 100 million ARR and onwards.
Yeah, so many aspects to consider on that journey. Vishal, 2 questions sprang to mind. One is, as you're at the stage post 10 million ARR, all of this optimizing, are you really gearing up to get profitable, or is that way down the line?
Yeah, every business is different. I can only really speak on kind of how I run mine. Other people run theirs differently. Right now, with the opportunity that we have to sell our product into legal teams that really don't have anything, we are just investing in just trying to capture market share as fast as we can, right? Be the brand that people associate with when they think about buying contract management technology, right? To that end, it's really the ratio of how much did you burn in a year to how much your ending ARR is, right? The pundits will tell you that like a 1-to-1, like we burned $30 million, right? So that's, cash coming in, expenses, and then that's whatever is left is burn, right? So I burned $30 million and I'm going to end this year at 30 million ARR. Like that's really good 1-to-1. Then as you kind of think about the journey ahead, like 25, 50 million ARR, 100 million ARR, try to want to make that ratio get better, right? You try to burn 50 million ARR, make it burn $50 million and then make it to 100 million ARR. Then it's like getting like really great, right? You're like 50 cents to $1. And then in the years to come, like as you think about your company is very large, probably now your company is going to get very large very soon. You start thinking about, can we maintain the same burn rate and continue to grow, right? And continue to, that's like efficiency of growth. Eventually, Peter, there could be an inflection point where your expense structure is not massively increasing every year. Your burn is not continuing to go up, but your ARR is going way higher. And then just through free cash flow, you have the opportunity to be profitable. But you really, in the early days, you got to think about it like 1-to-1 is really good. Like 50 cents to $1 is really, really amazing. Like that's like very elite, right? Somewhere in there, you understand that the business is actually running very efficiently. Right. And that's what kind of later stage investors look for, right? That's what, B, C, D, E investors, they really look for that scaling. Like, can this thing make it to $1 billion ARR? If this thing was doing $1 billion or 100 million or 250 million ARR, how much money would it be consuming to make that happen?
Got it. So your efficiency on return and your burn rate is kind of, you're looking for that to go up as you the return you get on your burn rate as you scale and scale. The other question that sprang to mind was, you were talking about hypothesizing on the route to market that works for you and the customer fit. Have you experienced that changing throughout this journey, and how has it changed, if so?
Oh, totally. It's like an onion, right? You start the company and it's like a whole onion. You don't know what's in the middle. So every month and every day and every week, you continue to learn more, right? So many people I've seen just jump into like, we built a product and now we're going to go try to find a buyer. And that's like absolutely the wrong way to get started, right? You should really think about, I have a problem. Now let me go talk to a whole bunch of people who like are the potential buyer of a product that could solve this problem. Instead of going, let me go build software and then go to the customer later and say, ta-da, look what I built. And they're like, well, I don't really like this, or it doesn't work with how we already work, or we already use something that does something like this, right? It's like problem, customer, then go build the solution, right? Instead of problem, solution, then I'm going to go attack the customer. That is usually a recipe for disaster. So really knowing who your customer is, and we're refining it constantly, right? For us, it's like, is it bigger companies, like publicly traded companies with 10,000 employees, or is it smaller companies, right? Is it companies in the United States, or is it companies elsewhere? Is it companies in one of 20 industries, or every other industry that a company could possibly work in? And you're just constantly using data to say, we're having really good success in, whatever, like, 1,000 to 5,000 person companies in these 25 industries. Okay, great. Like, let's not do anything stupid. Let's keep doing this. Now we can experiment on other stuff, but you're not like risking your revenue number every quarter, right? Every year on like experimental go-to-market hypotheses. You can experiment with it, but hopefully by the time you're at 5, 6, 7, 10 million ARR, kind of like how that foundation of predictability, and how are you going to make your number every quarter? That's the other thing with taking money from VCs. It's like, what have you done in the last 90 days? Like we live and die every 90 days. We're coming up on quarter end here in June, right? It's like another quarter. Q1's gone. Q4 last year's gone. Now we just think about Q2, and Q2 will be over. We're on to Q3. Q3 is over. We're on to Q4. Like, it's all about making sure you can make it, right? And then how you build your models based on actuals, right? Like, I have actual science behind how much I think my reps can produce a year. And we've trended it for years and years, and we're not trying to like 2x that number and be hopeful. There's no hope that can go into Excel spreadsheets. It's more or less the truth. And try to dial it down a little bit, be more conservative, right? And you can then show up with better numbers and make everyone happy.
Yeah. So in the earlier days, there's more experimentation. You're peeling off more layers of the onion. But as you get to say 6, 7, 8 million ARR, you've got a better idea. You're experimenting less, and you're being able to predict and forecast more accurately.
Yeah, we do 80-20. We do 80-20. Like 80% of the time, we're doing exactly what we always do. 20% of the time we can experiment to learn something, and maybe some of that 20% goes into the 80%, then you're experimenting on the next 20%, right?
Yeah, got it. Hey, Vishal, this has been awesome. Thanks so much for the chat. I think you packed in so much in just under 15 minutes there. So I wanted to thank you for your time. And then also, how can people follow up if they want to learn more about LinkSquares or more about your own story and your journey?
Yeah, sure. Check me out, linksquares.com. That's the company. Follow me on LinkedIn. Feel free to add me on LinkedIn.
Awesome. Well, thanks for joining us, Vishal.